Hey guys, Chris from Adapt Tuition here, and in this video, I'm going to show you the solution for question 3 from the Jan 2011 PoA Paper 2. If you want to see the solutions for the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the question. Okay, so it reads that as at November 30th, 2010, the following personal account balances existed in the sales and purchases ledgers of Small Moon Enterprises. Okay, so we have existing in the sales ledger a balance for Marshall. So the sales ledger holds the accounts of all of our debtors, our trade debtors, people who owe us money from credit sales. And then in our purchases ledger, we have a balance for Hamilton. So the purchases ledger holds the accounts of all the people to whom we owe money for credit purchases of stock, our trade creditors. Now, what else does it go on to say? It says then that the following information was extracted from the company's day books, the journals, for the month of December 2010. All right, so first up, we have the sales daybook or sales journal. So the sales journal records only credit sales of stock. So we're seeing two credit sales, both to Marshall, $25,200, $8,002. Next up, we have the purchases daybook, right? So the purchases daybook or purchases journal records only credit purchases of stock, no other asset. So on the 6th and the 29th, we have purchases only from Hamilton, $3,150, $2,250, okay? We also have the sales returns daybook showing that Marshall made a return to us on the 6th of December for $3,100. And then we also have the purchases returns daybook, the returns outwards daybook. And on the 11th of December, we sent back some goods to Hamilton with $415. We also have a cash book. Let's take a look at that. So we have a balance brought down of $5,200. We have Marshall for cash sales, $400. Marshall for credit sales, $26,000. On the credit side, the payment side, the 28th, we have Hamilton for credit purchases. So we're paying off some of what we owe. And Hamilton for cash purchases, $500. We have a balance carried down, $16,001. Okay, what do they want us to do? Let's take a look at the first thing up. Right, so A part 1 is saying prepare and balance the personal accounts appearing in the ledgers of Small Moon Enterprises as at December 31st, 2010. 9 marks. Okay, so back up to the top. Once again, we have two accounts. One in the sales ledger for Marshall, that's a debtor, and one in the purchases ledger for Hamilton, that's a creditor. Let's deal with the sales ledger account first, which is the account for Marshall. So you've seen that account here, trade debtor, Marshall. You could put sales ledger on top if you want, that's fine. Okay, the first thing we're going to put in for Marshall is Marshall's opening balance, which should be on the debit side. Why? Because Marshall is a debtor. A debtor is an asset. Assets have debit balances. Okay, we're going to scroll down and take a look at the sales daybook. The sales daybook shows that we made 2 credit sales to Marshall, which means Marshall will end up owing us more money because we're making more credit sales to Marshall on the 4th and the 21st. Now that will go on the debit side of Marshall's account because debits increase assets. And again, if we make more sales to Marshall, it means that Marshall is now owing us more money. So the asset is increasing and assets increase with debits. Okay, now what about returns? We had a returns inwards, not so? A sales return? Yeah, here we go. We had one sales return on the 6th of December. So we're going to put that in on the credit side. Now why the credit side? Because if Marshall returns goods to us, Marshall no longer has to pay for those goods. Hence, the asset is coming down. The amount owed to us, because Marshall sent back some goods, they no longer have to pay for those goods. Hence, the total amount owed to us is going down. That's a decrease in an asset, which is recorded via a credit to the asset account. We also saw Marshall paying us some money. Now, we have 2 sets of payments here. And this would have caught a lot of students. The only payment that is relevant to Marshall's debtors account is for credit sales of $26,000, right? So we're going to put that in on the credit side because, of course, when Marshall pays us back, Marshall is reducing the amount of money owed to us. That's a reduction or a decrease in an asset. And to record a decrease in an asset, we have to credit the assets account, right? Now, why are we not recording the cash sales? Well, if Marshall made cash sales, the double entry would simply be to debit cash book and credit sales. Marshall's account would not be involved, okay? So that's why this item here is not going inside of Marshall's debtors account in the sales ledger. Now, I think that's about it for the entries to go in Marshall's account. So we have to balance off Marshall's account. Now, how do we do that? Well, we add up the items on the debit side, we add up the items on the credit side, and we subtract. That's going to give us a balance carried down of 36,602. If you add up both columns now, you're going to see they give us the same total of 65,702. And of course, if a balance is carried down from the credit side, it must be brought down on the debit side, as you can see here. And of course, this corresponds well because assets have debit balances. So that's that one. Let's take a look at Hamilton's account now in the purchases ledger. So we're going to go back up to the opening balance for Hamilton, which we will see is 19,290. Now, Hamilton is a creditor. That's a liability, which has the opposite rules, double entry rules, relative to assets. So Hamilton's opening balance will be on the credit side because liabilities have credit balances. Now, the next item up will be from the purchases day book. That's going to give us all of the credit purchases, all made from Hamilton. One on the 6th, one on the 29th for $31.50 and $22.50 respectively. So credit purchases will increase the amount of money we owe to Hamilton. That's an increase in a liability, which will be recorded on the credit side. Now, what about debit items? Well, we have that one returns out to Hamilton on the 11th with $4.15. So if we send back goods to Hamilton, we no longer have to pay for those goods, which means our liability is coming down. There's a decrease in a liability, which will be recorded with a debit to the liability account. Now, what about the cash book? Well, we had two items for Hamilton on the credit side, did we not? We had Hamilton for credit purchases and Hamilton for cash purchases. So just like we said, the cash purchase, that will be debited to purchases and credited to cash. Hamilton's account will not form part of the double entry and hence will not be affected by the cash purchase. The payment for credit purchases, yes. So it's on the credit side here. So guess what? Every credit needs a corresponding debit entry. So that's going to be on the debit side of Hamilton's account, just like this. And again, if we are paying Hamilton back some of the money, we are reducing the total amount we have for Hamilton. And to record a decrease in a liability, as I said before with the returns outward, you have to debit the liability account. Okay, those are all of the items that go inside of the account. Now the balance, how do we find that? Well, just as we did with Marshall's account, we add up the items in this column, add up the items in that column, and we find the difference, and we put it on the side with the lower total. So clearly this side has a greater total than this side. So this debit side will need the balance to be carried down from that side. Of course, now when you add up both columns, you get the same total, and when you bring the balance on the credit side, you're good to go. And again, this makes sense because Hamilton is a creditor. A credit is a liability, and liabilities have credit balances. Okay, that's it for part A. Let's take a look at part B. Okay, so what I meant to say was A part 2. So it says prepare and close the sales and purchases accounts in the general ledger of Small Moon Enterprises as of December 31st, 2010 format. Okay, so the sales and purchases accounts in the general ledger. Let's take a look at the sales account first. So the sales account would have credit entries to record cash sales and credit sales. So let's go up to the sales journal, right? So this is all the information we have regarding credit sales. So we'll add these figures up to get total credit sales and put it in the account. And don't forget, down in the cash book, we had a cash sale to Marshall of $400. So we have both cash and credit sales. So we're going to populate those items in the T account across here. So you're going to see sales journal 33,202, which is the sum of the two sales figures or items in the sales journal, and then the additional 400 here. Now all we have to do again, so the balance to be carried down is simply the sum of the items on the credit side here. And you're of course going to have a total there, and the credit balance is brought down here. Now, it's set to close off the account. When you close off an account, it has to be, first of all, a temporary or nominal account, a revenue account or an expense account. Sales to revenue account. To close it off means to transfer the balance to the income statement. I'll repeat that. To close off an account means to transfer, if it's a revenue, the amount earned to the income statement, and if it's an expense, the amount incurred to the income statement. Sales is a revenue. To close off a revenue item to the income statement, it means we have to transfer this credit balance to the income statement. To remove or transfer out this credit balance, we have to go on the debit side to make that entry. And that's going to say income statement. And now the account will have no balance carried down. because we transferred all out of the income statement. So we're debiting here and we're crediting income statement, which makes sense because our revenue is a credit item. Okay. Now, with that done, let's take a look at the purchases account. Now, purchases is an expense. And just like with the sales account, we're going to have a credit purchase component and a cash purchase component. The credit purchase component will be found in the purchases daybook or the purchases journal. So we can see two credit purchases here. This will total to 5,400. And if we look down on the credit side of the cash book, we're going to see the one cash purchase item of 500. So both of those items are going to go on the debit side of the purchases account because purchase is an expense. And when you incur the expense, you have to record that on the debit side of the account. Now, of course, you're going to balance off with the balance being carried down from the credit side and then brought down on the debit side. And just like we did with the sales figure, we have to close off, the sales account, we have to close off the purchases account by transferring the total amount incurred, because it's an expense, to the income statement. So there's a debit balance existing in this account. To transfer it out, we have to put a credit entry to remove it. That's going to say income statement 5,900. And when you total up both sides, there's no balance carried down or left over. Okay. All right. Now that's part A. There is a part B. So let's check that out now. Okay. So part B reads, the following balances were taken from the books of Metalworks Enterprises on April 30th, 2010. An inexperienced bookkeeper placed some items in the wrong column. Okay, so here's our trial balance. Now, rather than go through all of these items, I'm going to pull up the trial balance on the other side. And as we go through the items, we're going to put them in the column one time. Now, just so you know, the instruction says to rewrite the trial balance for Metalworks Enterprises in good style, including an amount for capital. Okay, so we're going to go through these one by one. So land and building is an asset. Assets have debit balances. So that one seems to be in the right column. Bank overdraft. Now, bank overdraft is in the debit column, but bank overdraft is a liability. That's where we spend more money than we have in the bank, and the bank had to lend us money in order to spend. So therefore, we owe the bank money. And anytime we owe anybody money, that's a liability. So this should be in the credit column. So we're going to put that there. Cash on hand is an asset. Assets have debit balances, so that was fine. Accounts receivable is an asset. Assets have debit balances, so that was on the correct side. Carriage in is an expense, which has a debit balance, so that's fine as well. Carriage out is an expense, which has a debit balance, right? It's not the opposite of carriage in. So it's not a liability or a revenue, right? It shouldn't be in the credit column. Accounts payable is a liability that is supposed to have a credit balance, so that's fine. Rent received is a revenue, so that's supposed to be on the credit side, in the credit column rather, so we're going to put that there. Motor vehicles is an asset, that's supposed to have a debit balance, so that's fine. The allowance for depreciation on the motor vehicles is 12,000. That's supposed to have a credit balance, so that's fine. Purchases returns or returns out is supposed to have a credit balance, so that's supposed to go there. Sales returns or returns in has a debit balance, so that's in the wrong column, so we're going to put it in the right column. Commission paid is an expense. Expenses have debit balances, so that's fine. Loans, and the loans is a liability. That is supposed to have a credit balance, so we're going to leave that right there. Sales is a revenue. That has a credit balance, so we're going to put that as it is. Purchases is an expense. That has a debit balance, so that's fine. Drawings is a reduction in capital, and capital decreases with a debit, so that's supposed to have a debit balance. Salaries is an expense, so that has a debit balance. Now, remember the instructions said that we need to find an amount for capital. Capital is equal to assets or debits minus liabilities or credits. So we're going to add up this side, and then subtract. And that's going to give us a capital figure of 73,850. And when you add both columns, you get to 271,800. And that's the end of the question. Okay, guys, so there you have it. That's the solution for question 3 from the Jan 2011 POA Paper 2. If you have any questions about it, please feel free to leave it in the comment section below, and I'll get back to you when I have a chance. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe, and be sure to check out my website where you'll find some pretty useful POA handouts. Anyway, guys, as per usual, thank you so much for watching. Take care of yourselves, and I'll see you next time. Bye.